Welcome to the Landlording Show. I am your host, Tim Harstead, and today we're actually going to start a series. The next few episodes, we are going to be talking a little bit more than we normally do about acquiring properties. Next week's show, we're actually going to have on a broker who's going to show us how to analyze. But today, one of the most important parts, getting financing for your investment properties. I have a great friend and a great colleague, Laura Dantuma here. She's with Femme Capital. Laura, thanks for coming on. Tell us a little bit about yourself and Femme Capital.
Well, thanks for having me, first of all. Femme Capital Partners started about 3 years ago. I've got 33 years in the business. And I built and sold the first mortgage company. And in deciding to open up Femme Capital, I said, what can I do to align my knowledge in the lending business with a passion? And that is bridging the gap between women and capital. So we opened Femme Capital, and although we lend to everybody, we've got a vast portfolio of past clients. There is a specific focus on bridging that gap between women and capital.
Awesome. So most of our viewers are investors and people looking to buy investment property, whether it's a single family home they're going to rent out or, buying bigger properties, aspirational properties that can really take over their 9 to 5. I wanted to dive in. First of all, a lot of people just don't understand the different type of loan options and the different types of things that they can do to get either better rates or get some things that they thought they couldn't qualify for. Can you go into sort of some of the different loan options when you're buying investment properties?
Yeah, lots to talk about here. So I'll cover just a few of them that are the most sought after. SBA is a big lending vehicle for commercial multifamily specifically. Conventional, so banks in the commercial lending space often will portfolio loans. So those are called conventional. And then there's the government sponsored Fannie and Freddie 2 to 4 unit lending types. There's bridge financing, there's hard money financing and mezzanine financing. And then of course you have construction financing for multifamily. So SBA is more for bigger properties then, or how does that work with SBA? No, not necessarily. So SBA can be used for anything from 4 units up. So 2 to 4, we're talking about the residential space. 4 units up, we're definitely talking about the commercial space. And that's where SBA as a government loan product can come in. So that's where you can either go after the conventional loan types or the SBA loan types. And then we can dig even deeper on SBA because it's a government sponsored program. Just like on the residential side, 2 to 4 unit, you have FHA. On the commercial side, you have SBA. And so with SBA financing, you've got 2 types. You have a 7A and you have a 504. And the important differences between the two are a 7A is usually used for business purposes. So equipment, inventory, refinancing debt. And then the 504 is going to be used mostly for acquisition. So purchasing real estate.
Cool. And how do you decide, FHA, a lot of times, like I can talk on the residential side, the FHA versus conventional, generally conventional, you'll get a little bit better rates, but FHA, you put lower down payments. So How does it work when you're looking at commercial versus choosing between SBA or would it just be standard commercial loan? We'll call it for commercial.
So when you're going conventional, typically a conventional lender is going to look for 30% right now in today's climate. SBA is nice because you usually can qualify for a 10% down payment, which frees up your capital for improvements or, just reserves, savings. So that's what's kind of nice about that. On a 504, you also can qualify for 10%. Down payments can go higher on a 504 up to 20%. But in some cases, you can, typically I should say you qualify for 10% down on those. So it's a much lower down payment. And what's nice about it is there's just a little bit more flexibility. So, we can finance through the SBA, you can finance things like capital improvements. You can finance operating cash or capital, I should say. And so it just offers a little bit more flexibility. 7A products can also offer you equipment financing and things like that.
That's cool. So I think, dig a little bit deeper into it. I think the number one, we get a lot of clients that come and go, and the ones that we see fail, like real estate it's an investment, and with investment, there's risk, right? And the good news is by educating yourself and knowing all this, you can actually mitigate most of that risk. But I think the majority of the time that we see people fail, it's because they don't have reserves. We see someone that comes to us and they have, we have this building that has 3 units and 2 of the tenants need to be evicted. I have no money coming in. So that's an 8 to 10 month, process with no money coming in. And then you have to believe this or not, when tenants get evicted, they don't leave the property in the greatest shape most of the time. So now you got to do a 10 grand rehab and after just having 10 months of no money. So a lot of these people get caught in this trap where now they have 10 months of what I call economic vacancy because they did an eviction, and then another 10 months because they don't have the funds to rehab the property and get it up there right away. So I think that's a huge lesson for people is there's products out there that can help you to get these fixes done, to get these rehabs done. Mm-hmm. But as well as if you can put down less, it doesn't mean you should have less money necessarily, but you need to have that reserve put away. And I've been preaching that on other episodes of this podcast. It's a huge thing.
It really is. And when we, as a lender, sit down, and we'll talk about this later, but when we get into the cash flow portion of the analysis for approving or qualifying somebody, we weight heavily on the ability to have a reserve account after the down payment and any capital injection from the perspective of improvements that need to be done. So if we're not financing those improvements, we want to know that you've got the ability to bring the building up so that your market rents are attainable.
And then with that 10% down, the SBA that you can do 10% down with, how big can that go up to? Like if we're, I preach a lot about what I call the monopoly strategy. So if you're a new investor, you're buying single family homes or 2 flats and 4 flats, and eventually you're going to sell them. And once you have enough equity to buy something bigger and keep going that route, how big can a loan like that go up to where you're putting down 10%?
I've done one loan up to $5 million. So I'm doing one right now at $3.5 million. So there's some great capability for borrowing power there.
Awesome. Cool. So like when we're looking at the 2 different kinds of SBA loans, is there, with FHA and conventional, we talked about a little bit how the rates will vary. What about on the SBA side? Is one better than the other?
That's a great question. For 504, generally they offer the better rates, the 504 loans versus the 7A loans. While more flexible, the rates tend to be higher on a 7A. So when you're comparing the two, depending on your needs, right? So is this an acquisition? Are you looking for capital to do improvements? Is it, refinance versus acquisition, et cetera? You're going to want to compare the rates on both and just take a look at your overall cash flow with the person who's doing your loan to figure out which one is going to be better for you.
Cool. And then I think the last, question on the difference between SBA and conventional that I got is just the process of getting a loan. I know for running a company, an SBA loan is like pulling teeth. How does it look in the mortgage sense of info needed and versus a conventional?
Yeah. So on the conventional side, it's easier because it's a bank portfolio loan usually. So the bank knows exactly what their underwriting guidelines are and what they require. Not that they don't know what an SBA loan is going to require, but those are guidelines set by the SBA. So even though a bank can overlay to some extent and add layers of requirements to an SBA, they're still going to usually follow SBA guidelines. So the process is very similar for both in that you still do the application. They're still going to look at things like, the difference between a residential loan is that they're really looking at the person on a residential loan. So 2 to 4 units, they're looking at your credit, they're looking at your debt ratio. On an SBA, they're going to more heavily weight everything on the cash flow. So the part of the process that's important and why you deal with a broker versus going straight to a bank is that I know what any given bank is looking for from a cash flow perspective and how they weight various aspects of that cash flow. So that part of the process is very important. But just like residential, it's the same type of thing. You go through an application process, you go through a processing process, and then you go straight to closing. So it's very similar. What takes longer on the commercial side is honestly aspects like the cash flow, getting that right from the beginning. But more importantly, the appraisal. The appraisal on a residential loan, you can have, 5 to 7 days typically. On a commercial loan, those can range from 3 to 6 weeks, depending on the type of property it is. And the costs of commercial appraisals are significantly more. We're talking a difference between, $500 to $700 or $750 on average to thousands, sometimes upwards of 5,000. It just depends on the type of building.
Gotcha. Cool. And so what should we expect? Let's say hypothetically, I'm looking at buying a 10-unit building, putting together a contract. What would I be looking at timeline in terms of closing?
I would say 60 days is the average. Oftentimes, if we have a hard time with sellers and getting their the leases and all that kind of stuff that really realtors should get up front for the potential buyer. I just recently had one that went close to 90 days because we couldn't get the proper leases signed, et cetera, from the seller. So it's 60 to 90.
Gotcha. Awesome. And then the other thing you talked about was with commercial loans looking more at the building than the person. And I think right now, one of the hot topics on all the investor boards, Bigger Pockets, all that is these DSCR loans. I know you guys do them and know a little about them. Can you explain to the audience what those are and how they work?
Yeah. So DSCR is a term that commercial is used for forever. So it's really the cash flow of the building in comparison to the expenses. So you cash flow the building with the rents, your expenses, et cetera. And then, take that expense and compare it to your principal, interest, taxes, and insurance. And that ratio is what the bank is going to be looking for in order to approve the loan. Usually we're looking at 1.20 on that, a DSCR ratio of 1.20. But basically what that means to anybody buying is 20% left after you pay the expenses on the building. So you bring your cash in and then you subtract out the principal, interest, taxes, and insurance, and then that and your expenses, and that'll show you what your ratio is.
Cool. And how do you guys get that, or what are the banks looking for in terms of to prove that? Assuming leases, I know you talked about as one thing to show income coming in, but how does a bank determine what expenses on a building are?
Yeah, I mean, that historically can come off of the seller's tax return. Most of the time they'll provide those. Oftentimes they won't, and if they don't, then they would have had to provide income and expenses over to the listing agent so they could provide that to any potential buyer. So it's important to look at that stuff before putting an offer in, right? So if I get somebody that calls me and says, hey, I have the rent roll and leases, I want to send it over to you, I've got the expenses, can you take a look at this and run a cash flow analysis for me? That's the first thing we're going to do. We want to sit down and we want to look at that for you as, your potential lender. and review it and say, hey, this looks like a great building, or hey, based on the cash flow, this isn't looking so hot. So either let's take a look and see, are they at market rents? Is there room to increase those rents? Because, some of these sellers have had tenants in there for years, sometimes decades, believe it or not, and just never brought their rent up to market rent. So as a new buyer coming in, I want to make sure that my building is cash flowing at its maximum ability. The other side of that is, can there be improvements done to the building so as to increase rents and bring them up to marketable rents?
Yeah. So I think two things sort of, not on the buyer side, but on the seller side, just to touch base on, either if you're a listing broker or if you're someone thinking about selling. One is, I know as investors and as business owners, we like to write off as much as we can, and we like to show as little income as we can, or and sometimes in that case, even hide income, which you shouldn't do, but some people are. If you're looking at selling the building next year, it's important to make sure all that income's on your tax return. What would you say if I was a listing agent and I'm taking on a building? What documents should I have ready to go? I think you said the rent roll. What else would you make a quick list of?
Inevitably, we're going to ask for 3 years tax returns of the buyer, so that we can analyze the buyer's ability outside of this building to cover their own expenses, et cetera. We want to make sure they're secure. So we'll look at credit. Credit's a little less heavily weighted than residential. We really look, you know how residential goes. You either qualify or you don't from that perspective. But really looking at the cash flow of the person's either business or main job to cover expenses. We're going to look at 60 days of assets, all assets. So if you have a business on commercial, you're providing business bank statements for every account, personal bank statements for every account. So every asset listed on your personal financial statement, we will require 60 days of proof of that so that we can look at it. It's 30 to 60 depending on the bank. So I like to just get 60 up front so we're not going back and forth. But the 3 years tax returns, and then of course, like I said, and you repeated, the rent roll and expenses.
So let's talk about, again, I always preach what I call the monopoly strategy, starting off small, buying a few smaller buildings, and then eventually when the market's right, selling those when you have enough equity and moving up to a bigger building. So for those starting off in that arena, what do loans look like if I'm looking at a 2 to 4 unit building? Are there programs that I can get less down payment for, or how does that all look?
Yeah, on the residential side, 2 to 4 units are, there's so many opportunities to borrow there. Again, though, it's conventional or government. There's some private money, some hard money. We don't obviously get into that. We can refer out if somebody's got blemishes on their credit or an inability to cash flow personally. But on the government side, we're definitely going to be looking at, well, actually altogether, just on average, on a rental property, I think it's safe to say anywhere from 10 to 30% down is what we would look for.
All right, and then for down payment, like if we're buying a smaller property, 2 to 4 units for a down payment, what does that look like? I know you said 10% on the SBA. On the lower ones, are there any discounts there? Or how can we do that?
Yeah, we're typically looking at about 25% on a government product. But some of the banks will go a little bit less. Sometimes 20 is hard to find. Again, that would be somebody with extensive reserves. But I would say a good rule of thumb is 25%.
And then what are we looking? I've seen some banks do it. Does yours or the people that you work with? Are we looking for any kind of reserve or anything else, or is it just the when you're buying a residential house for yourself to live in, there's a lot of times where you can put down less, 3 to 5%, and then get the sellers to cover some of the closing costs, things like that. are banks looking for any kind of reserves or anything like that with the smaller units?
Yes, definitely. 6 to 12 months is usually pretty safe. I like to tell people on the conservative side, 24 months of reserves keeps you in a really good place, because if somebody moves out and you go, a month, 2 months rehabbing a unit because it got, like you mentioned earlier, it got torn up from a bad tenant, then that's imperative to be able to cover that expense in time. But then more importantly, if you don't get a renter in there, depending on the climate, I mean, we've gone through dry spells on the rent side. Right now, we're not experiencing that. We haven't since before COVID, but you want to make sure you have 60 to 90 days to cover yourself in addition to that, rehab time.
In Chicago, I think we just call that winter nowadays. I mean, I know what you're talking about before COVID when it got really slow, but we definitely get, from November to February here, our average rental time, maybe 3 weeks right now. In December, it's easily 6 because no one's out showing apartments or looking at apartments Christmas Day and New Year's Day and all that. So if you end up vacant and without, when the rehab's not done till the winter, you can be in for a little bit of time. So with that, I think the other strategy a lot of investors look to use, especially starting off with the 2 to 4 units, is what I call house hacking. It's a big topic where, hey, I'm gonna live in one unit, I'm gonna rent out the other unit to 3 units and have them pay my mortgage, and I can put down less. So can you talk about some of the programs where you can put down less money using FHA or things like that? And just the advantages of that.
This is a hack that's near and dear to my heart because I love the first-time home buyer as much as I love the first-time investor. So somebody who's a first-time home buyer who's got the wherewithal and knowledge to seek out answers about investing from the very beginning, this is a perfect hack for. So you basically move into the building, 2 units or more, and you live in it as an owner-occupied building. And so what you're looking for is the cash flow of the building to cover the whole mortgage. So in essence, if the second unit that you have in a 2 unit covers your principal, interest, taxes, and insurance, you're living rent-free, so to speak, or mortgage-free at that point. So it's a way to free up cash flow monthly on the personal side, because your housing expense is completely covered. But then more importantly, Fannie and Freddie like to see you live in that property for 12 months. But to be able to do that for a minimum of 12 months, say upwards of 3 years, and then move out and go buy, say you move up from a 2 unit to a 4 unit and you live in it for another 12 months or 2 years, and then you do the same thing. You're acquiring real estate as you go. All the while, your housing expense monthly has been covered by the other people's rent.
Now, do I have to, let's say I get to year 2, do I have to refinance out of the FHA loan to go get another one? Or will they let me move and have another FHA loan?
As long as you live in it for the amount of time that you've lived in it, you can move out of it. But you can really only have one FHA loan at a time.
Yeah, so you'd refinance one and then you'll get another down payment. Awesome.
Right, but by that time, we've got some equity in the building, and it gives us a nice ability to use that equity to qualify then for a conventional loan program or something like that on the next building.
Cool. So I want to talk a little bit. I'm actually going to skip around a little bit on you just because it sort of brings it up. But we're talking about refinancing, and I know that a lot of people are stuck in this. That was the plan, right? 3 years ago, and they had it. But they're stuck on these 3% loans, 4% loans. And either they're running out of time if they got a loan that has a balloon on it, or, they want to refinance to buy something else. What are we seeing in rates, and what do we think, so the future holds in the market?
Right. So on commercial rates right now, I mean, the whole commercial spectrum is looks and feels exactly the way listening to these economists talk about the economy looks and feels. Mm-hmm. It's all over the place. So one day you'll talk to a commercial lender or a bank that will say, we're out. We're sitting on the sidelines. We're going to wait for this economy to, get itself together, inflation to go down. We want the commercial real estate market to feel really good before we come back in. And they'll go sit on the sideline. And there's many banks doing that right now. So from that perspective, we lenders feel a little bit of a tightening. But then you'll talk to somebody 2 days later and they're tired of sitting on the sidelines. They see something coming around the corner by way of recovery, and they're jumping in full speed ahead and throwing extra capital behind them. So from a lending perspective, the climate is all over the place right now. And that's what's so good about using a broker, is that I'm able to vet that. I'm on calls all week, 10 to 15 different investor calls weekly, where I'm getting updates about how, loan committees are feeling it, various different banks or lending institutions. Mm-hmm. And so it's important for me to know which of those banks are going to welcome your loan submission package with open arms, and which are from the very beginning looking to push it away. Does that answer that?
I feel like most people, I feel like most people think about insurance agents in that way and understand, and that's how I'm going to relate what my question is, sort of give you a softball there. But a lot of people know about insurance brokers versus going to, what's called a captive agent like Farmers or State Farm, where they can only quote one product. So, right. But I don't think a lot of people realize the difference in lending, that there's a similar thing where you're a broker that's, selling many different products from banks versus captive. So tell us a little bit more about sort of those advantages that you guys have being a broker versus, going somewhere with that's like, I don't want to call anyone out, but I'll say Chase, who only sells Chase loans.
Right, right. So a borrower walks into a bank unknowing. They don't understand what the guidelines are. They don't understand how to analyze those and look at those, as they shouldn't. That's not their full-time job. But they go in, they submit a loan package, and the banker submits it. It comes back and it's denied. And then they walk out, they go to the next bank, they submit the same loan package, thinking that they've addressed the issue, but again, don't understand this lending institution's guidelines, and they get denied again. That in itself is why you use a broker, because when you come to somebody like Femme Capital Partners, we will sit down and do your analysis. We'll put the package together based on what we know that bank is looking for. So we understand their guidelines and we know whether or not you qualify from the beginning. Now, that's not to say that we're not going to submit a package and there's going to be something in there that they don't like. The good news is we've already got that package packaged, put together, and we can make some tweaks and then send it over to the next bank if need be. It rarely happens, but it could. So, and again, that speaks to the importance also of using a property manager like yourself. Mm-hmm. We as lenders want to see that if you have experience in managing properties, that you're using a property manager. And if you're not using, if you don't have experience, it's still important to use a property manager, because that property manager knows exactly what it takes to cash flow that building and keep up the maintenance of the building. And they've got the wherewithal to do it. You're paying them to do it. So, and not only that, but they also know what to look for. And in some aspects, people managing buildings are doing that as a part-time job, or it's like it's going to be their retirement. They're not experienced from the perspective of knowing who to call, or knowing how to manage the increase in rents, or even knowing how to find what the increase in rent should be. So it's important to us that people go out and get a property manager. We do have a lot that try not to, but we highly suggest it.
And I'll speak to that a little bit too. something that comes up a lot because there's two times clients call us. They call us the week after they bought or the week before. And some of the times the smart ones that are calling the property management and getting that in place, what to budget. So when you're running numbers, the exact amount to put in your budget to make sure it's going to cash flow. But B, and I am in Illinois, property management's a realtor license. I've been a realtor for many more years than I was a property manager. So I'm going to say 99% of us are awesome, but there is that 1% that are going to try to make the property sound better than it is. We got a call, one time from a guy. He bought a building and thought the rents were all going to be $1,800, and we ran comps. And he just closed. He's like, all right, you can rent it out. It's great. All right, cool. So we're going to market it at $900. I mean, this guy completely had no idea. He was out of state buyer, had no idea what he was buying. He bought in the middle of the south side of Chicago in one of the cheaper neighborhoods that you can find. And literally you pull up Google Maps and there's nothing but boarded up houses on the block. And he's like, but it's really nice. I was like, that's great that you have granite in there. You have all that, but
it's really nice that it's not cash flowing.
Yeah. People like nice houses, but they also, it gets discounted when there's nothing outside. So things like that, things like, we've taken over properties where a building closed and they thought they had cash flow, and we walked the unit and it's completely, there's no tenants there. Like literally they were getting a rent roll and they never had anyone. And that's sort of where, especially with realtors now, especially now, I think you're going to see buyer representation less and less with the whole NAR thing. A seller's agent's job is to get it sold. So, not that they should tell lies or anything, but if you're not asking the right questions and if you're not doing the walkthrough properly, you're not going to see these things that, hey, yeah, they say someone's in here, but all there is a blow up mattress. Like this tenant's not staying. This is not a home. So I think those are really big things to look out for and to sort of make those calls. And, we have conversations all the time where, there's potential clients that are buying other properties that will call us and just say, hey, run comps on this neighborhood, run comps on this building, go to the inspection for me. And these are things that a property manager should do for you to give you that third party view, because they actually have to deal with all the crap that comes afterwards. So, sometimes a realtor.
We love teaming up with people like you, property managers. Like, we'll have our sophisticated buyers call and say, hey, here's my property manager's name and number. Get together with them and figure this out for me. And we're happy to do that. It saves a lot of time. The emotion is taken out of it, and it's now a business transaction between the lender and the broker, I should say, and the property manager. And we're able to really get quite frank with the buyer and say, yes, this is a good deal, or no, it is not. And we can see it up front. It's vivid.
Yeah. And then I want to go back just really quick on the broker versus bank thing. How often, and this is a two-part question, because I want to talk about first this question and sort of the part about why it doesn't matter, but rate-wise, let's say I'm the perfect candidate, I can qualify for anything, and you have 3 or 4 banks. How often do you see a big rate difference, and how big of a swing can bank to bank be?
Right. So on the multifamily programs, there can be a pretty big swing. I mean, I've closed with a 1% gap between bank to bank. Same scenario, same prepayment penalty. The prepayment penalties are usually a 3-2-1. First year 3%, second year 2%, third year 1%. But just comparing apples to apples, I've seen a 1 point swing. And that also goes for closing costs. I mean, some of these banks want to charge their own costs, and then the broker has their costs. But what we typically find is that banks partnering with brokers will split the fees. So, they'll decrease theirs so that we can charge ours, and it comes out the same in the end for the buyer.
So, and you sort of started bringing it up, but closing cost fees are a huge one. And I think sort of planning out what your end goal is, in the sense of, are you planning on keeping this building for 5 years, 2 years or 20 years, because I think that's going to make a difference in,
Very much
you
so.
save 0.25%, but you're paying an extra 10 grand in closing costs. If you're only keeping it for 5 years, you're never going to make that up. So talk about that a little bit more, about the differences and sort of how to compare the whole package, I guess, if I'm deciding between two banks or two offers.
And I think that when somebody calls me and I'm doing my initial interview of that potential buyer / borrower, one of the things I do say is, how long do you intend to keep this building? Is this a house hack, right? Is this going to be something where you're going to keep it for a long time, but you're only going to live in it for a certain amount of time? And how long on a multifamily building are you intending to keep it? So if somebody says to me, hey, I'm looking to get out of this, I want the equity and I want out of it in 5 years because we're moving, or because I'm going to invest in a bigger building, whatever the case might be, we're going to run that closing cost analysis just like I run the cash flow on the building, to see if they're able to make that money back in due time. If not, then that's a conversation we have to have. Just like right now on the residential side, I'm getting a lot of people that are saying, hey, I want to do a buy down. Well, that's great. We can do buy downs all day long, but how long are you going to be in this property before we refinance and take advantage of the bottom? And what if that bottom is 12 months away? So we have to sit down and be honest with a buyer or borrower from that perspective and say, look, I don't think this is the right time for you to do a buy down, because I don't know that you're going to make it back. So yeah, those are important conversations.
It's absolutely. One more thing, you talked about buy down, you talked about that. We're now starting to see a lot of these investors that sort of, when the rates started creeping up, started taking those sort of jumps of faith that they were going to fall right away, and have, balloon issues, or have issues where they thought they're not cash flowing properly because they thought by now they'd refinance. What do you have any advice for them, or any way to get, if I have a balloon coming up, and it's just the rates are just crazy compared to how I'm cash flowing? Any suggestions on that beyond trying to get your money back in the sale?
That's an excellent point. And one that enough people don't think about up front. That's something we do with our post-close conversations. So we're calling you, a year later to make sure everything's going well, give you some closing documents just in case you've misplaced them or whatever, for tax time. But we're also going to want to talk to you at least a year and a half is a good time frame prior to your term expiring. Most commercial multifamily loans are written on a 5-year term. So if I'm going to give you a 5-year term, you're going to want to know a year and a half out that come that lease renewal time, you are maxed out on your rents so that your cash flow is where it needs to be to qualify for your renewal, whether it be us taking it to a different investor or renewing with the same bank that you're already with. I always tell my borrowers, whether you're going to go back to the same bank or not, re-engage with us so that we can tell you and work between yourself and your property, us and your property manager. We're going to want to tell you whether or not you're in a good space to do that. So I would say year and a half, so that come that lease renewal time prior to the term expiring, you're set. You know where to put rents.
I think that's pretty much all the questions I had for you. I want to thank everyone for listening, and thank Laura for coming on and giving this information. We're going to have all of Femme Capital and Laura's info in the description. So if you guys are looking for loan products or think about buying or need to refinance, reach out to her. She's a great resource. She'll definitely help you guys out. So thanks again, Laura. Did you have anything to say to close out?
Thank you for having me. And like you said, give me a call if you're just even wanting to ask questions and see if investing is for you. We can meet for coffee or talk over the phone and just map things out.
Very cool. Awesome, guys. We'll see you in a couple of weeks, and hope you guys enjoy this episode.